Okay, everyone, thanks very much for joining us here today for BOQ's FY14 results announcement. My name's Karen Munsey. I'm the Group Executive for Corporate Affairs. I'd like to welcome everyone here in Sydney as well as on the phones and the webcast. We're going to have our Acting CEO, John Sutton, and our CFO, Anthony Rose, present the FY14 results, and then we'll turn to questions. So I'll hand straight over to John. Thanks very much.
Well, thanks very much, Karen. Well, good morning, everybody. Thank you for joining us today for BOQ's results for the financial year ended 31 August 2014. Before I get into the detail, I'd like to take the opportunity at the outset to thank former CEO Stuart Grimshaw. Stuart joined the bank in November 2011 and played a significant role in turning this bank around, and on behalf of the entire BOQ team, I'd like to thank him. I can assure you that the executive team that Stuart has brought in is committed to delivering on the strategy that we've been successfully executing over the past 3 years. It remains business as usual at BOQ. I'm joined in Sydney today by all of the executive team, with the exception of CIO Julie Bale, who is in Brisbane given the announcement today of our new IT services contract, which I'll touch on later. Turning to slide 2. It's certainly a pleasure to stand here today to deliver another record set of results, a stark contrast to where we were just 2 years ago. In terms of the agenda this morning, I'll provide an overview of our strategy and results and then hand over to Anthony to run through the financials in detail. I'll then come back and talk about our priorities for FY15 and sum up. On slide 3, you can see that by all key measures, FY14 was a strong and successful year for BOQ. These figures include 1 month contribution from BOQ Specialist, the former Investec business we acquired earlier this year. I'll talk more about BOQ Specialist later, but I can assure you that it's performing in line with the expectations and we're pleased with its progress. The heads of this business, Barry Lainsman and Andre Carney, are here in the audience today. Turning to our numbers, our statutory profit was up 40% to $260.5 million, which includes the $22 million impact from the settlement of the Storm litigation. Cash earnings were up 20%, while EPS rose a healthy 15% to 89.5 cents a share. ROTE has seen a strong kick up, rising 130 basis points from this time last year to 13.2%. Also worth noting that ROE is up 100 basis points from FY13 to 10.4%. Finally, shareholders have been rewarded with a final dividend of 34 cents a share, taking the full year payout to a fully franked 66 cents a share, a 14% increase on 2013. Turning to slide 4, I'd like to reiterate our strategy. Just over 2 years ago, we put in place this simple 4-pillar strategy to transform BOQ. While the strategic pillars outlined in the 4 boxes on the slide might not be the same language as in the past, it's the same strategy in more user-friendly language and has resonated well with our customers and staff. The first pillar of the strategy involves opening more doors to more customers by putting customer in charge. A good example here is our entry into the mortgage broker market. The second pillar focuses on balancing risk and return or growing the right way, for example through diversification of our business bank. The third pillar involves becoming more operationally efficient or finding there's always a better way. That's why we're investing to digitise our back office to take paper out, reduce rework and speed up the time to yes to give customers a much better experience. The final pillar involves having the right people, capability and culture to ensure success or being loved like no other, which is evident in our strong ongoing customer satisfaction measures. So what you see today is a bank that has come a long way in less than 3 years. Strong foundations are now in place and we're well into building a bank that is lower risk, lower volatility, and set up for a strong, sustainable future. I'd like to turn to slide 5 and talk about the key highlights for the financial year. We've delivered a strong shareholder return for FY14, again outperforming on a TSR basis, with BOQ returning 39% compared with the 18% for the financial index. Our disciplined approach to lending has continued in a low credit growth environment characterised by intense competition in mortgages and growing competition in business lending. We're simply not prepared to compromise credit quality or join the race to the bottom on pricing, particularly when competing against major banks with significant capital advantages. While this has impacted our retail growth in particular, you can see that we are managing the levers we can control to deliver strong underlying results. A key takeout from this result is the quality and strength of the balance sheet, which reflects the significant work we've done to embed risk management, culture and process over the past 2.5 years. Anthony will cover our balance sheet and capital position in more detail, but I want to recognise there's been a lot of chatter in the market about bank capital levels. I'd have to say that we're pretty comfortable with where we sit. If you look at the S&P risk-adjusted capital ratios, we're well ahead of the pack and well positioned to deal with potential changes. In terms of costs, we're continuing to invest in the frontline resources in retail and business banking to enable us to open new channels, as well as productivity and efficiency improvements such as back office digitisation. It's absolutely no joke to say that Australia Post are probably dreading us completing this digitisation, as we would have to be one of their best customers. We're world class at shuffling paper. Fax machine manufacturers, that 1980s icon, need to also be wary of a significant downturn from BOQ. Finally, I'd like to call out BOQ Specialist. For the first month under BOQ ownership, it's delivered $3.1 million in profit, which is right in line with expectations. We're already starting to write mortgages on our balance sheet. Turning to slide 6, and I'll now provide some details behind the drivers of these results. We're particularly pleased with the ability we've shown to strongly manage our NIM, which is up for the 4th successive half. You've got to manage both sides of the balance sheet, so while competition has been intense on the asset side, we've taken aggressive action to manage the liability side hard. We've also benefited from 2 credit rating upgrades earlier in the year, taking BOQ to an A-band rating for the first time in its history. Our exit margin for the group, excluding BOQ Specialist, was consistent with our second half performance at 185 basis points. We expect BOQ Specialist to add around another 9 to 10 basis points in the year ahead. On slide 7, you can see that our cost-to-income ratio remains below 44%. Our expense growth was higher than we would have liked, although we've had a number of one-off costs to deal with, which Anthony will talk to. We're also in the progress of making substantive investments in line with our strategic pillars, such as building a broker capability, which will deliver benefits in future years. I can assure you that we are committed to disciplined management of our expense base. After an 18-month rigorous tender process, we today announced the re-signing of a new 5-year IT services contract with our existing provider, Hewlett-Packard. This replaces a highly inflexible, outdated 10-year contract and will provide significant cost savings. For example, our enterprise storage costs will be around 60% lower, and the contract has been structured to allow ongoing cost savings to be achieved as changes in technology costs emerge. This is not something that we've been able to take advantage of under the previous contract, which was quite inflexible. The significant cost savings this new contract will provide will allow for further investment in the business and help us shelter us from the impact of increasing amortisation profile. Turning to slide 8, One of the areas I'm personally most proud of is the work we've done to improve our risk position. Having been in the industry for 20 years and lived through a couple of cycles, I know how important having the right risk culture is. We now have risk appetite statements, triggers and limits in place across the portfolio, while geographic and industry concentration limits are regularly reviewed. Risk-related KPIs are also in place across all business lines. Our impaired assets are down 25% in 2014, as is our impairment expense. You'll note there's been a small increase in commercial and BOQF impaireds in the second half, and Anthony will discuss these in more detail. Finally, our arrears trends are also improving, particularly in the commercial book. Let's turn to slide 9, where we'll have a look at growth in retail and business banking. In terms of housing loans, it's clear we're growing below the rest of the market. While we would prefer to be growing faster, we're not going to loosen our disciplined approach to pricing and risk. We're also still dealing with legacy issues like the run-off of the line of credit product and our paper-based systems, while growth in Queensland has also been well below the national system. Our channel diversification strategy is kicking in to drive more volume, and we've doubled our broker numbers from half to almost 1,200 across 5 broker groups, which is a long way away from the zero presence we had just 18 months ago. In August 2014, we originated around 14% of applications through brokers. Given now that brokers account for around 43% of all mortgages written, we still have plenty of upside, particularly as we're only just starting to roll out in Queensland. What's also been very pleasing is the diversification of the book that we're seeing with brokers. For example, we see more PAYG customers and the credit quality has been solid. In terms of owner-manager branches, we're starting to see improved metrics. Half on half, settlements per owner-managed branch has improved 8%. In the corporate network, we continue to bed down significant changes to roles and responsibilities, aiming at improving productivity. More than 50% of the branch managers are new to bank, and all roles are now customer-facing. Our branch network remains in a period of transition, with branch numbers reducing, largely in the owner-manager network, due to consolidations and retirement after a number of years in the network. On a net basis, total branch numbers were down 18 for the year. We remain confident that a sustainable growth profile in mortgages is not far away, which I'll talk later in the presentation. In the meantime, we remain focused on what we can control and in executing our strategy. Turning to business banking, we've continued to see solid growth, and we build our capability and expand geographically, targeting specific industry sectors and niches to capitalise on those segments where we are most competitive. I'd like to call out BOQ Finance on this slide, which is the quiet achiever in our portfolio. It's growing modestly in a market which is flat to negative in terms of growth, given the subdued business sentiment. Brokers are telling us that the market is as quiet as they've ever seen, and small business in particular are still delaying investment decisions. Slide 10. I'd like to talk particularly about BOQ Specialist Acquisition, which is a great fit with our strategy to grow the right way. The business operates in a high-growth industry segment, delivering high margins, low impairment expenses, and provides us with additional diversity in terms of industry and geography. Just 2 weeks into BOQ ownership, this business had its first on-balance sheet home loan written and approved, which is a very impressive effort. The business has been originating around $1 billion of mortgages a year, currently funded by third parties. We're expecting to fund around 50% of those originations via our balance sheet within a year or so, which will assist us with our growth in mortgages. We're also seeing referrals from BOQ specialists to other parts of the bank, such as our private banking. The momentum in this business can be seen by the fact that it has grown $215 million in assets from the time the acquisition was announced to the end of August. Pleasingly, we've retained all key staff critical to driving this business forward. We are prepared for heightened competitor targeting of our customers after the acquisition announcement, and the business responded quickly to ensure we lost no major customers, and in fact, we have seen customer numbers grow since the announcement. Slide 11 talks to our culture and capability, which is ultimately about driving improved customer satisfaction. In terms of the retail customer satisfaction, Net Promoter Score remains well ahead of the major banks. Looking at high advocates, those who score us between 8 and 10 out of 10, we achieved the largest annual improvement of the major and regional Australian banks. In our business bank, we continue to outperform our peers in customer satisfaction surveys, leading the pack in the Eastern Partners Business Banking Index for 6 years running, and recently achieving a record high. We continue to drive a culture of difference in BOQ, where it doesn't feel like you're working in a big bureaucratic bank, and our goal remains to deliver top quartile employee engagement. I'd like to turn to slide 12 and talk a little bit about our management targets before I hand over to Anthony. As we've said in the past, these were 3-year targets set at the end of 2012. And while the business has changed a great deal since that time, we continue to use them as a benchmark. So Virgin Money Australia and BOQ Specialist are excluded, given these targets were set well before those acquisitions. Retail asset growth was a miss for both halves of the year, for reasons I've already covered, while expense growth was a miss in the second half. But pleasingly, we continue to track well ahead against most targets, and NIM in particular is a long way ahead of the target. I'd like now to hand to Anthony to run through the financials before I return to wrap up. Thanks, Anthony.
Right. Thanks, John, and good morning to everyone. It's a pleasure to be here today to take you through the details of what is a strong result. And whilst we acknowledge that there is more to do to place the business on a sustainable growth trajectory, it is a result that the whole management team and our staff can be very proud of. To begin, I'll provide a quick overview, starting with slide 14, before drilling into specific drivers in further detail. As John's already mentioned, we've posted a cash earnings after-tax result of $301 million for the full year, driven by 2 key factors: strong improvement in net interest margins and a 25% decrease in loan impairment expenses. In our investor information pack lodged with the ASX this morning, we have split out the result to show the impact of the BOQ Specialist for the 1 month since the ownership commenced on 1 August. In addition, the current year's earnings per share and return on equity metrics were diluted by the fact that the equity raising to support the acquisition occurred in advance of the settlement. In effect, the cash raised in April and May through the entitlements issue sat lazy on our balance sheet, earning the RBA cash rate, obviously well below our cost of capital, until we completed the acquisition. In the investor information pack, we have provided a pro forma analysis that eliminates this impact and demonstrates the bank's underlying performance. One of the most pleasing aspects of the result is the improvement in the bank's return on tangible equity, which excludes goodwill. What this reflects is the rate of return we achieve on each dollar of investment that we can put into our organic growth opportunities. If you eliminate the impact of the BOQ Specialist acquisition and the associated equity raising, the bank's ROTE increased by 170 basis points to 13.6% for the year. In fact, if you look at the second half, it's up 90 basis points to 14.1%. It's a pleasing result and is comfortably above the 2015 management target of 13% plus that we set in 2012. If you turn to slide 15, you'll see that our lending growth has remained subdued as we maintained a disciplined approach to pricing and risk. We've continued to diversify the book geographically. With the acquisition of BOQ Specialist, our Queensland concentration is now at 54% at the end of 2014, down from 60% in 2012. Business banking momentum is still strong and well above system, so I'll focus on our housing volumes. The broker expansion has contributed $280 million worth of growth during the year, but 3/4 of this growth was realised in the second half. We're now at a size and scale where we're confident to expand into the Queensland market, where our brand will have strong resonance with potential new customers. Our paper-based processes mean that we are resource dependent in this channel, which has played out in our cost growth. What this means, though, is that as our end-to-end lending digitisation is delivered, we can significantly increase the current throughput in this channel without requiring a net increase in resourcing levels. In terms of the transformation underway across our branch network, there is no doubt that parts of the network have found this transition more difficult than others. As an example, the owner-manager network in Victoria experienced runoff in the order of $120 million during the course of the year. In our New South Wales corporate branches, where branch manager turnover has been highest, settlements were down year on year off a pretty low base. Given recent talk about housing activity in both of these markets, it's clear that we have not been getting a large share of this activity. Our changed risk appetite also means we are losing some customers where we have extended finance to in previous periods. These are hard decisions to make, but true to our disciplined approach when it comes to risk management and improving the quality of our portfolio. We remain confident that the steps we're taking in our branch network, along with the productivity gains that will flow through from our digitisation initiatives, will facilitate growth in the years ahead. This, coupled with our expansion into the broker channel and opening up of the BOQ Specialist channel for mortgage origination, puts us in good stead to get back to system growth. Moving to the liability side of the balance sheet on slide 16, you can see that we've been able to further improve our deposit to funding composition, with a deposit to loan ratio at 69%. This has been helped, of course, by the acquisition of BOQ Specialist, which added $2.2 billion in deposits. We've taken decisive steps to improve our funding mix, given the lower asset growth we've been seeing, which has obviously flowed through in better margin outcomes, as you can see if you turn to slide 17. Our margin expansion has been a highlight of the year's performance, as I mentioned earlier. This has been the single biggest driver in the lifting of our return on tangible equity to over 14% in the second half. Despite significant front book repricing and the low interest rate environment impacting earnings on capital and transaction accounts, we did achieve a 13 basis point improvement in net interest margin over the year. This has been driven, as I said before, by a movement in our retail liability mix, but was also helped by the fact that there was little strain from the low balance sheet growth. We also leveraged the rating agency upgrades to extend counterparty limits, and were able to take advantage of improved credit spreads in wholesale funding markets. It's a great example of how being small sometimes does provide better ability to manage the levers at our disposal to deliver revenue growth. If you look at the half-on-half comparison on the chart, we've actually had a pretty consistent margin expansion across both halves when you take out the BOQ Specialist noise, which I'll explain. The impacts in the first half: asset spread reductions of 7 basis points, funding cost improvements of 14 basis points, and a reduction from capital and low-cost deposits of 2 points, were largely repeated in the second half, with the deposit pricing impact being about 1 basis point higher in that second half. What's played out over and above that in the second half result is the impact of the free funding benefit of the capital raising in advance of the acquisition settlement, which was about 2 basis points, and 1 month's contribution from BOQ Specialist in the result. So the underlying NIM for our existing operations was 1.83% for the half, with the exit margin, as John said before, at 185. We would expect to maintain the exit margin profile in the year ahead, but we want to caution against simply extrapolating the recent NIM expansion in future periods. Front book lending spreads and low interest rates will continue to place downward pressure on margin, and further deposit repricing initiatives are going to be required to maintain the NIM position at this level. As John said earlier, the BOQ specialist business should add in the order of 9 to 10 basis points to the group's aggregate margin position on a full year basis. Moving through the P&L to the other income, I'm now on slide 18. Although it seems we're seeing improvement, we'd caution against reading too much into these trends in the last two halves. We are seeing continued pressure in banking fee income as customers increasingly move to fee-free products. The implementation of the amended APS 210 liquidity standard has resulted in a change in composition of our liquids book. Favourable movements in credit spreads, particularly in the semi-government securities portfolio, generated trading profits within the portfolio that have been classified in the other bucket on the chart. I'd caution that this trading result should not be considered consistently repeatable. Other income has been negatively impacted by customers in the BOQ Finance operating lease portfolio, continuing to hold assets beyond contracted terms, which does result in lower realised residual value gains at the end of lease equipment sales. As John mentioned before, that is a symptom of the lack of confidence in that small business sector of the market that business is positioned to. Conversely, that plays out in an offsetting increase in net interest income as increased renewal income is recorded. St Andrew's insurance contribution of $41.6 million to non-interest income for the full year is a 3% improvement from the prior year. The distribution agreement that St Andrews has with Bankwest did expire in September, however has been renewed on a short-term basis whilst we continue to negotiate a longer-term agreement. I do want to call out a change that's occurring in the St Andrews business. Sales of single premium policies have reduced, which is a part of a broader industry shift. Regular premium policy sales have increased significantly, and this is likely to continue in the coming year. However, while still delivering attractive margins, the product is generally lower return than the single premium business, which is in decline. This will act as a headwind to the insurance income in the years ahead. Turning to expenses on slide 19, cost to income ratio was 43.9% in 2014. There have been a number of one-off costs increases in the second half of 2014 in particular, which have increased our expense growth above our inflation target at 6%, excluding BOQ Specialist for the full year. The one-off costs include duplicate and onerous Sydney and Brisbane head office rent charges, as we've been relocating and consolidating our major head office spaces, as well as some lease surrender costs associated with branch closures. We expect a similar level of these transition costs in the 2015 year as we complete our Brisbane head office move. Excluding these impacts, expense growth in 2014 would have been 4.5%. This figure, as John mentioned earlier, is still higher than we'd want it to be. However, does reflect the expansion into the new channels and investment in frontline capability. The group is in the middle of undertaking a strategic transformation requiring significant investment, moving from legacy manual paper-based systems to electronic data and workflow managed capability. As John mentioned, we've entered into a new IT outsourcing agreement with Hewlett-Packard, which is a substantial change in both capability and cost profile compared to the previous 10-year-old agreement. So while we will experience an upward trend in technology amortisation in coming years, it will be sheltered by cost savings expected from the new IT operating model and outsourcing agreement. You'll also note an increase in employee costs as we've made further investment in frontline capability. As I highlighted earlier, with our manual processes, greater scale means more people. That will change with the delivery of our digitisation program. The wash-up of all of this is that the current inflated expense profile is a symptom of the current business evolution as we reinvest in building a better and more sustainable bank. We expect to return to a normal profile upon delivery of the key pipeline projects which are well progressed. The current cost-to-income ratio is expected to be maintained in the 2015 year until the productivity efficiency benefits of these transformational initiatives are realised in the 2016 financial year and beyond. This is expected to deliver a recommencement of reductions in our cost-to-income ratio towards our low 40s target. If I then turn to the impact of BOQ Specialist over and above the profile I've just covered, this is a much higher margin business, as we've talked about, but it also runs at a higher cost to income ratio. The full year impact of BOQ Specialist into the bank's group cost to income ratio is expected to create a 1% step change. Moving to impairment expense on slide 20, which is tracking in line with our 2015 management target of 20 basis points. The chart on the slide shows the movement across the various portfolios. You'll note the significant movement in impairment charge in the commercial portfolio in particular. You'll also note there's been some volatility period to period in the BOQ finance business. This portfolio has performed extremely well through the bad debt cycle that we've just experienced, and again has produced another solid result for the year of 56 basis points to gross loans and advances. The first half result was well below through the cycle levels, but we did see the second half return to the long-term trend we'd expect for this business. While the overall portfolio metrics have remained solid, a small number of larger exposures relative to this portfolio, and by that I mean in the order of $1 to $2 million in that range, did become impaired in the half with higher loss given default rates than normal. We'd consider this outcome to be within normal tolerance levels for a leasing portfolio of this nature and have no cause for concern, but we remain ever vigilant. Looking at the movements in impaired assets on slide 21, and I'd like to think this is a chart we can cover relatively quickly, where previously it required the most commentary. You can see that reductions have continued, with total impaired assets down 25% on a full year basis. It's pleasing to note that this is the first half period since the asset quality review in 2012, where no exposures greater than $5 million have transitioned to impaired status throughout that half. Whilst you'll notice a slight uptick in new impaired assets in the second half of the year in both the commercial and leasing books, we're not seeing any signs of stress in these portfolios that are causing us concern. I covered the lease book earlier, but in the commercial portfolio, we've continued to see a steady flow of the small end of the SME exposures that originate under the bank's previous risk settings. It's evident, however, that the bank's increased focus on credit hygiene is contributing to higher inflow because troubled accounts are being identified earlier than they would have been in the past and are being transferred to our asset management group to be managed appropriately. The experience in this portfolio is best considered as the natural flow of troubled exposures through the arrears buckets and into workout strategies. When I cover the arrears on the next slide, you'll see a material drop in the volume of commercial loans going into the front end of the arrears pipe, so the momentum is definitely trending in the right way. Moving on to arrears on slide 22, both housing and BOQ finance arrears are relatively stable and at acceptable levels, although the housing book still demonstrates some residual echo of the past risk appetite statement. As I highlighted when talking to the previous slide, commercial arrears have improved significantly, with both 90 and 30-day arrears levels reducing by over 40%. Now, some of the 90-day improvement is as a result of those arrears migrating to impaired status. However, what's most pleasing, as I called out before, is the 30-day arrears bucket, the front end of the pipe, has dropped sharply. I'd now like to move on to slide 23 and cover BOQ Specialist. Whilst the financial expectations remain on track and consistent with our guidance at announcement, as John mentioned earlier, the momentum in the business is very pleasing, with mortgages already being written on our balance sheet. Obviously, the earnings on a start-up mortgage book will take some time to come through, particularly as there will be an associated reduction in third-party commission income that the business has previously been earning from other banks. But it does provide long-term value creation, and in the short term will certainly help in lifting our housing growth towards system levels. Moving on to capital on slide 24, and we've been able to maintain our very strong Common Equity Tier 1 ratio of 8.63%. Our internal capital generation continues to support our dividend growth, with 47 basis points of capital being taken up by the BOQ Specialist acquisition and Storm Financial legal settlement in 2014. There's been a lot of debate in recent months about capital levels and how much is enough. We've shown in the peer comparisons on slide 25 for a number of periods now and they continue to tell the same story. BOQ's Common Equity Tier 1 ratio compares very well to our peers. Whilst the major banks have been making a lot of noise about the different deductions, add-backs and potential increases that might be required in the numerator of this equation, they've remained silent on the denominator, which is where really the main difference lies. S&P's risk-adjusted capital ratio that does adjust for this, and as you can see on the chart, BOQ remains well ahead of our peers on this measure. With that, I'll hand back to John to wrap up and discuss the outlook.
Well, thanks very much, Anthony. I'll now continue to take you through our strategic priorities in FY15. If we turn to slide 27 and the retail business in the year ahead, we'll continue to focus on making it easier for customers to choose to deal with us, whichever channel they choose. In the mortgage broker channel, we had close to 1,200 active brokers across the country at the end of August, and we've accredited 100 more brokers in Queensland late last week. We expect around 2,500 accredited broker numbers by the end of FY15. With digital assets, we're seeing significant growth, albeit off a low base, both in lending growth and also lead generation for our physical sales channels. We've seen almost 10% growth in traffic to our website and a 13% increase in average time on pages, and we continue to evolve our online presence. We remain very committed to our owner-manager model, which remains a key competitive advantage in regional and outer metro communities in particular. A key driver in FY15 will be the new commission model and franchise agreement that will start rolling out as soon as the new franchise code is finalised. This model provides better alignment of interest for both parties and will reward those who adopt the right approach, for example, an increase in cross sales. For the past year, owner-managers have had full visibility of the new balance scorecard, where they rank versus their peers and what they can do to improve their ranking. We're also working hard to upskill our franchisees, turning them from good bankers to great small business operators who excel in banking. Our Fit for Biz coaching program has rolled out to 69 franchisees nationally, and to date we've seen significant incremental increases in business activity. Our corporate branch and mobile banking channel will continue to bed down changes and drive productivity higher. We're also piloting what we're calling icon branches, one in New South Wales, one in Queensland, which bring a new style of service to our customers, and the early sales figures are encouraging. I also talked earlier, BOQ Specialists will also provide a new channel for mortgage growth as well. So while our mortgage growth hasn't been where we want it to be, we remain confident that a sustainable growth profile is not far away. This reflects the upside in the broker channel, the productivity improvement programs underway to lift the performance of the branch network, and an addition of BOQ Specialists. One thing we will not be doing, however, is changing our disciplined approach to both pricing and risk. Turning to slide 28. We expect further growth in business banking given the frontline investment of the past 18 months as bankers build their pipelines. We're focused on growing this business the right way, which means targeting customers who help us diversify by product, geography, industry sector and asset class. We take a disciplined approach to pricing for risk and wherever possible seek to provide a whole of banking service proposition which covers transaction banking, leasing and foreign exchange. We've already discussed BOQ Specialists provides us with additional distribution and diversification capability and will provide another important growth dimension to our business bank. Turning to slide 29. We continue to believe in the potential of the Virgin Money Australian brand. In credit cards, for example, VMA was one of only 2 players in the market to grow assets organically in the last year, and it has now close to 200,000 customers, none of whom are ever likely to walk into a BOQ branch. We remain committed to manufacturing and distributing banking products through VMA. Although it's taking us longer than we expected given the limitations of our systems, we will continue to work on this opportunity in the year ahead. Our St Andrews insurance business continues to diversify its revenue streams. New partnerships include life insurance with Blue Ink under the Let's Insure brand, while since financial year end, it has also secured the right to manufacture the life cover component of CUA's CCI products. Turning to other FY15 priorities, while transitioning to our new IT services contract with HP, a relatively low-risk transition given our existing relationship. The delivery of our lending platform will be one of the biggest transformation programs we have ever undertaken. The first phase is underway with the new records management system now in place, with the lending platform scheduled to pilot from April 2015. Productivity and efficiency benefits are expected to begin flowing through the 2016 financial year. Before summing up, I'd like to turn to slide 30, and obviously a very topical subject is the financial systems inquiry. We've worked closely with other regional banks to make a contribution to the FSI and presented a strong case for change around regulatory capital, particularly with respect to residential mortgage risk weightings. It appears there is now widespread agreement, not only in Australia but internationally, that the current playing field is completely inequitable and that steps need to be taken to address the issues. We remain hopeful that between the FSI, the G20 and global regulators, we'll see changes that will benefit standardised banks such as ourselves. We're also hopeful that the funding advantage enjoyed by the too big to fail banks will be eliminated or offset to remove the funding benefits of the 2 rating notch uplift they currently receive. We have also asked the FSI to look at the increasing vertical integration we're seeing with the mortgage broker and aggregator groups, given the proportion now owned or partially owned by major banks. We think it's critical there is a more transparent disclosure around ownership and flows. Finally, we're advocating more certainty in terms of understanding what recommendations will be implemented and the timeframes we can expect. On a related issue, there's been a lot of discussion in the market about the property price bubbles and the potential use of macro-prudential levers. From our perspective, the property issues relate primarily to the investors in the Sydney and Melbourne markets, an area where we are less well represented. While some type of macro-prudential change to moderate activity appears likely, it'll be important to ensure there are no unintended consequences for other markets which have not seen the same level of outperformance as Sydney and Melbourne. With slide 31, I'd like to sum up before going to Q&A. FY14 has been a great year for BOQ, with record profits and strong shareholder returns. In the year ahead, we'll continue to execute against our 4-pillar strategy with an emphasis on pursuing profitable growth. We won't chase growth for growth's sake or be tempted to move higher up the risk curve, but we do see upside from continuing to expand our distribution channels and unlocking the potential of our branch network. A full year contribution from BOQ Specialist will also assist growth. We are committed to managing costs as tightly as we can, recognising that there is a lag between investment in our transformation program, which has significant pipeline to deliver, and the productivity and efficiency benefits we expect over time. In terms of business conditions, we expect FY15 to be similar to the past year and remain well placed to capitalise on any improvement to the Queensland economy, which will benefit if the recent fall in the Aussie dollar is sustained. In summary, there is no doubt that solid foundations are now in place. We're on the way to building a better bank that is lower risk, lower volatility, and set for a sustainable future. Thank you. We remain confident in BOQ's future, subject to the macro conditions, and expect sustainable growth in earnings and dividends to continue. And I'll now hand over to Karen to facilitate the Q&A. Thanks, Karen.
Thanks very much, John. We're going to take questions from the floor first in Sydney. Can I ask you to please wait for a microphone so that participants on the webcast can hear? And then we'll take questions from the phones. And can I also ask you to please stand up so our microphone attendants can see you? I might start here with you, John.
John Mott from UBS. Quick question. One of the comments that you had towards the end is that you want to grow in retail, but there was a big definitive no change in pricing or risk. And especially on the broker channel, I just wanted to explore that a little bit. You're seeing a lot of your competitors, one regional bank in Queensland that's not yourselves in particular, putting the upfront broker commissions up to 80 basis points, and other competitors are aggressively putting prices up for brokerage rates as well to try and tap into that market, especially if the banks that don't have the same exposure to Sydney and Melbourne commercial property. So can you comment on, will you be able to do it if you do see, and continue to grow that channel, if you do see your competitors continue to push up their pricing there? And also on the risk side, you've mentioned that you don't have as much exposure to Sydney or Melbourne on investment property. Can you just give us a bit of a breakdown on how much investment property you have versus owner-occupied, the flow, and anything you do have on Sydney, Melbourne? That'd be great.
That's a nice way to kick off, John. I think you've asked about 4 questions in one. So I might start off with how we're going to compete in the broker market and talk about some of the pricing metrics that we see there. I'll hand over to Anthony to talk a little bit about what we're seeing in flows. But let me say at the outset, we've had a very, very definitive strategy with the brokers. We first of all went to AFG in Western Australia, a market that we're underrepresented in for a long period of time. And the feedback that we've got from the 4 broker groups that we're now with at the moment was that they welcomed to have BOQ on the panel. They wanted to have more competition. Where we are competing in that particular channel is that we're using our ClearPath product. It's not a switch and bait product like a lot of other banks actually have. It has a very low transparent interest rate, very low fees. What you see is on the tin is what you exactly get, and we're seeing some enormous uptake with that. As always, we review what our commission model should be with the brokers, but we are finding that they are supporting us. That they're supporting us well. Now we're moving that out through the eastern seaboard, and each month we're seeing incremental gains on the amount of broker volumes that are coming through. And just on credit quality, it's early days. We don't have great detailed vintage analysis because we've only just been there for a little while, but the majority of the proportion of what we're seeing is PAYG, which actually goes further to diversify our book, and the early indications of the credit metrics are very good. Do you want to talk about the other?
Sure, just to pick up on a couple of the points. Obviously, our portfolio in the retail space has looked a little bit different to a traditional portfolio. We've been overweight lock, and we've talked about that at length. We have also had a higher proportion of investor than probably a traditional bank. The new business metrics that we're actually writing today are trending much more like a traditional banking operation. In fact, our greater than 80% lending would be slightly below on our numbers what the average of the rest of the industry would be. And in fact, if you look at our investor exposure, the LVRs on that portfolio average around 65%. Does tend to be slightly lower LVR than owner-occupier for obvious reasons, just the nature of the property. So I think hopefully that captures your question.
I'll just add on Sydney Melbourne. I think last month our settlements investor for our total loan portfolio was 6.1% in Sydney, so it's negligible, and Melbourne was slightly higher. So we're not over-indexed there at all. Sorry, I can't see behind the lectern. I'm very short.
Richard Wiles, Morgan Stanley. I think it's slide 30 you refer to a difference in capital. It seems almost inevitable that the majors will be forced to lift risk weightings on their mortgages. But do you believe that you should get a reduction in your mortgage risk weightings what are you actually doing to convince APRA that you should have lower mortgage risk weightings? Can you give us an update on your efforts to get to advanced accreditation?
I might just make some opening remarks on that. I would never make a comment about any discussions that I have with APRA. But what we have done, we're very much on the public record through the FSI on what we're advocating, and we would be advocating lower risk weightings, particularly in that band of low risk mortgages, less than 80%. And Anthony can talk to some more detail on that.
Sure. There's obviously a number of factors, and it's interesting in the overall discussion around macroprudential levers and how does the regulator actually deal with a Sydney and Melbourne investor piece. Now, currently they've got a counter-cyclical capital buffer, but if they were to apply that, it would apply to all lending, which is a fairly blunt instrument. Clearly, one of the things we've been advocating is a more transparent capital regime. We currently have a standardised suite of banks, and we have advanced banks that operate with bespoke black box models, which lack, I think, the transparency to provide the resilience to the system that we would, I think, benefit the broader economy. And our view would be that the advanced banks should all be reporting on a standardised basis as well, and that the advanced outcomes are calibrated with maximum deviation from the standardised element so that there is transparency. There still needs to be appropriate incentive for advanced risk modelling capability. Clearly the gap is too large. I think that framework adds significant resilience. What it also would do in the macroprudential sense is you could put increase in risk weights on investor loans in Melbourne and Sydney postcodes on standardised banks, and you've immediately recalibrated the entire industry if you had advanced calibrated to standardised. As far as our path towards advanced accreditation, we don't have a characterised advanced accreditation program as such, but the steps that we're putting in place at the moment, the digitisation is absolutely the foundation building block to that path. We clearly have made a lot of progress in the market risk space, and I don't think our gap to advanced accreditation is significant there. We're expanding in the operational risk piece, and we've got a lot to do in that regard. And then in the credit modelling piece, we've made a lot of progress as well. So I think it's mainly getting that foundational digital environment. It's pretty hard to sit down with a regulator and prove validation when you have to then go and pull security packets to do so.
I'd endorse those comments that Anthony's made. Peter and his risk team have been on a tremendous journey in a very, very short period of time. And having been through 2 advanced accreditations at 2 other institutions, the bar over the years has been materially lifted higher by the regulator in terms of what's required. But we have a term within the bank we always use as well-run bank, and a lot of the work that Peter and his team has done have laid the foundation stones for us to get to advanced accreditation, and we'll continue to pursue improvements in our risk and our risk culture and our systems and process.
So could I just clarify, at this point there is no target date for submitting an advanced accreditation application to APRA?
We don't have at the moment, we're not going to put a date out there, but we are well and truly on the journey for putting the foundation stones and the layers needed for advanced accreditation. We're going to continue to watch very closely at what the outcome is with the FSI inquiry as well.
Well, Bendigo Bank started this journey a couple of years ago. It looks like it will take them 2.5 years to get to the point where they have submitted an application to APRA. Do you think that's a reasonable time frame for a regional bank of your size?
I couldn't possibly comment on what Bendigo's done or hasn't done. I come back to the comments that I've just made before, is that we're doing a lot of work around ensuring we've got the systems and process. Peter, do you want to add something to that?
It is a really good question, and we've pondered, particularly as the FSI has rolled through this year. Historically, the regional banks have adopted what I'd call a one-size approach. You have to do the full program for all 3 pillars: credit, market and operational risk. I think in the discussions that sort of been held in the public domain a little bit, and in the submissions we put forward, we did put forward the option of, say, delinking the three pillars, and I think that sort of we've had encouraging feedback that that's one of the options being considered. So you may not need to do the full program, and I think with our sort of firming the view that there will be some benefit to the regional banks come out of the FSI, hopefully. We thought it was silly to put in place an extensive program which requires significant capital investment over what you've pointed out is a long period of time, if there may be a shorter path to get the benefits of advanced accreditation without the full 5 to 7 year program. I would just echo John's points. We have actually been doing a lot of the work that you would normally see with the Basel II program to get us to well-run banks. So even though we don't call it a program as such, I think we're well placed to hopefully come up with a revised plan next year once there's clarity around the regulatory settings.
Okay, we might go down the back. Yep.
Thanks. It's Ed Henning from CLSA. Just going back to the retail and the growth there, can you just run through the issues in the owner-managed branches, and also with the change in the commission structure, is the worst behind you there? And just lastly on that, with the line of credit product, how much is remaining of that legacy to roll off?
Okay, look, I'll make some overall comments around our branch network, and then hand to Anthony. He can talk to the specifics around the line of credit product and what we're seeing there. Look, when I think about distribution for a bank, be it whether it's a regional bank or a Big Four, you've got to start with the customer first. Customers choose how and when they want to deal with you. Customers may start online. They may do some investigative work there. They may then move straight to a branch, or they may actually then choose to go to they may choose to go to a broker, and then ultimately they'll end up at the branch again, opening up an account. So what we're doing is looking at what the macro themes are, and we're always evaluating what are the appropriate channels of distribution. Now, I want to go back to my opening remarks. This is a bank that has largely ignored the broker channel for the best part of its, since its inception. It was in there for a little while, and 43% of all loans now come through a broker. So you ignore that channel at your own peril. So what we have done is opened up our growth, distribution growth through that particular channel. We stand by our owner managers. I was recently at the owner manager conference a few weeks ago. It's the third one I've attended, and I would absolutely have to say it's the most amount of confidence I've seen from our owner managers in the period of time that I've been at BOQ. We've had a reduction of 18 branches. A lot of those, some of those come down to owner managers deciding to amalgamate and actually grow their business and offer better servicing. Some have decided to retire, and some we've actually taken back, but not a lot. And it still remains dynamic, and we will continue to look at those distribution channels. It's a work in progress, but we're happy with where we are at the moment.
Just on the lock question, we had 700 million of runoff this year. We don't expect it to be as large next year, but it'll still be a headwind for us going forward, and it'll be not a significant, not a major reduction on that $700 million number. We were 21% of the portfolio. It's down to about 13% now, which is clearly back more towards risk appetite. If I look at the arrears position on the lock product, it's still more than double our traditional home lending, and that is where the bad debt expense has been overweight. So you look at our bad debt expense for housing is in the 12 sort of region. We would like to see that single digit, and if you actually just strip the line of credit product out, you'd be pretty much there. So it is a focus for us, but again, it comes down to the pricing discipline and the risk discipline of maintaining that focus. And we'll write. We've got a new product in the market, which is writing line of credit product for the right customer base, but there are still elements there that will continue to roll off.
We didn't sort of answer your question on commissions. So the thing I would say about commissions, the commissions that we currently pay our owner managers and what we also pay to our brokers are very, very, very similar. There's not very much difference. And in fact, as we roll out the new balanced scorecard that we talked about in my earlier remarks that will also drive further cross-sales across the network and also greater health in the O&B network as well.
And the main thing is the digitisation piece,
Yeah,
because
they're
to be
crying out
honest,
for it.
as an organisation, we talked about before, we've got one arm tied behind our back in relation to capital. Our owner managers and the corporate branch managers have got one arm tied behind their back in relation to the systems that they have to operate within. You go to a branch and you have to dodge the filing cabinets.
I'm Toll's best customer.
Just on the owner-managed branches,
Can,
do you think...
can we just wait for a mic, Ed?
Thanks. Just back onto the owner-managed branches, do you think from now, do you think you're going to see a happier mob moving forward from where you're sitting?
Very much so. I just go back to the remarks I made previously. I went to the owner-manager conference and it is materially different in terms of how they feel about where we're going. It's a true partnership. I attend the National Advisory Committee along with Matt. Matt and his team have done a wonderful job in reinvigorating the owner-manager network. They love the new branding that we have. They're on board with the products that we currently have. They're on board with the new commission model. There are already scorecards and ladders out there. And in fact, I had the chance to be out at one of the branches the other day where an owner-manager got absolutely all greens on all of his audits and was genuinely excited. And if I took you out to Parramatta, you'd probably, you're going to meet one of the most enthusiastic bankers you're ever going to see, who's got a lot of experience and really is a leader within his own community out at Parramatta. So we're very committed to the owner-manager network.
Craig?
Thanks, Craig Williams from Citi. Look, there's obviously a lot going right at the bank at the moment. The financial results are showing that and some good progress on processes and that sort of thing. You're calling out a wish to be Australia's most loved bank. Your net promoter score is 16.8 and the major banks are flat to negative on this score. So, but if I look at your retail loan growth, it's 0.1 times system. Your retail deposit growth, I think, was 1.8% this year, excluding the acquisition of the Investec book. So can you explain the relevance of the net promoter measure and what benefits being a more loved bank are in fact providing?
Yeah, look, that's a great question, and it's a journey that we're going on. It's a repositioning of the bank, and it's not only for external, for customers. It's also it's very much internal as well. So it's the way we approach everything we do within the bank itself. It's getting close to our customers, being less bureaucratic, getting our time to yes down. So something that I've been really close to over the last 2 years is this whole digitisation. And it's just an understatement to say that we've got so much paper. We have mountains of paper. And sure, we have been underweight this year in terms of our retail growth. But if you sat down with one of our owner managers and saw what he had to go through to get a home loan application entered into the system, and as opposed to what he'll have starting in April, is just chalk and cheese. So, we've been fighting with one hand behind our bank, and, it's a fairly emotive statement to say it's possible to love a bank, but it's something that everyone comes to work every day to try and do and live and eat and breathe. So I'm confident that we have the right strategies in place to actually get our retail distribution growth back towards system or slightly above system. And look, I want to say again, it's this executive team that is sitting here today that devised the strategy and is executing on that strategy, and we are making progress on that.
So how are shareholders...
Craig, can you just...
Yep. So how should shareholders actually see the benefits of this strategy being executed effectively over the next couple of years?
Well, I think they've seen a significant benefit today in the results that we've announced. There's been an increase in earnings per share. There's been a healthy increase in the dividend. And when you sit and look at running a financial institution, and I look at the history of this organisation as well, is that we want to make sure that we have got sustainable earnings per share growth, that we've got sustainable dividend growth, and that we have the right risk setting so that we don't have periods of volatility and that we can actually get through the cycle, each cycle. And that's really, really important. And everything you've heard here today is really building and bridging towards that. And that's what it's all about. It's not about short-term massive increases in profit. It's really about getting that EPS on a sustainable growth path, getting the dividends on a sustainable growth path, and executing what is, I believe, is a quite simple strategy. There is an absolute place for us. The customers are crying out to come away from a Big Four bank. Small example, particularly in the business bank. We talk a lot about the retail bank, but in the business bank, the people that can make a decision can be pretty much convened with a phone call. And we did that recently with a leasing deal which involved some helicopters for the rescue service in Queensland. And that was quite a complex deal. It was cross-border, but the decision makers were put on a phone around the table, and we gave the customer the answer they needed, and the other banks involved still had to go to their credit committees. That, to me, is a competitive advantage that we have.
If I could just maybe add, just to give you an example of how we, you called out 1.8% deposit growth absent BOQ specialist. If you actually looked at what we considered to be relationship deposits and the growth in that underlying part of the portfolio, we've actually had system growth there. What we've been doing is reducing the reliance on the high cost, and that's cost component where we, in fixing the balance sheet post-GFC, paid up for the real hot money, and we've just been unwinding that progressively as we go. So I think the resonance of the model is still working, and we're staring into some of the constraints operationally, but also the turnover of the portfolio into a new type of customer going forward that I think is where we're in at the moment. And also been out of the market in brokers, which has been obviously significant growth for other participants and less exposed in the areas that have had the higher system growth. Queensland's still below half of national system average.
True.
It's Andrew Triggs from Deutsche Bank. Just following on from that response, Anthony, how far do you think you are through that hot money TD roll-off? And your comments on the margin, do they relate to further, I guess, further to come on that, or is it more about the carded rates? And second question, just in the business banking space, well, obviously there's been very good growth. What sort of appetite is there at the moment for commercial property?
So in relation to the deposit space, you manage both sides of the balance sheet. So clearly we've had a year where we haven't grown in the asset side anywhere near as fast as we would want to. And as we look forward, we aspire to higher rates of growth. And I think the foundations that we've built in this year do put us in a position to grow at an accelerated rate in 2015. So your capacity to play those levers on the deposit side really depend upon what does the other side of the balance sheet actually do. So there are a number of moving parts to that. We still do have a significant presence in that more price-sensitive part of the market. That every bank plays in that space. Again, it just depends upon what pace of growth do we want the aggregate balance sheet to look like as to how much we're going to rely on that element going forward. In relation to appetite on commercial lending, I think one of the significant changes that we've got is our Executive Credit Committee, we sit with a portfolio matrix of understanding by geography and postcode where our appetite actually sits, and we regularly monitor that. We didn't have that capability, and it was just using the grey matter of the people around the table, whereas now we've got a much more considered approach that the front line can then go and leverage in the areas that they choose to spend their time and target new customer acquisition with a knowledge base as to where our broader appetite actually sits.
We're very disciplined about that. Again, having been through a couple of cycles and having a deep understanding of development finance and commercial property, we're all about a well-diversified book, and Brendan and the team are doing that. In fact, if you look at one of the strategies that we've been involved in was agri. We're currently well on the way in delivering growth in agri, but we've also actually declined quite a lot of business as well. So it's quite a disciplined approach to what we're taking. But the key takeout is diversification.
Nicole Mahalski from Merrill Lynch. Just going back to the movement of the paper-based system, you've described it as one of the biggest transformation projects you've ever taken on. You're talking about starting the pilot in April, and I assume hoping to get everything rolled out by the end of the year. How much of a constraint could that be on your capacity to write mortgages next year, for example, taking on the BOQ specialist book, and how do we think about that? And then just another one on the runoff of the book. You talked about the line of credit. I understand there's been some sort of concentrated runoff in some other parts of the book, and how do we think about that in terms of next year?
I might just start with how we're going to write mortgages, and Anthony, because he loves the line of credit, he can talk to the line of credit. BOQ Specialist has its own systems and process, and it's testament to the dexterity of that organisation that they were quickly able to see how they could actually put those mortgages on balance sheet on their system. So again, I'll go back to my earlier comments that they've been writing $1 billion of mortgages with third parties. We would like to see us writing 50% of that over the next coming 12 months, and they're well on their way. As far as BOQ goes, we've had to take, as we go for this transformation program, we've had to have a bit more of an intensive approach to servicing the broker mortgages at the moment through additional people on the ground to help us do that. But also that's around making sure we get the right servicing. So as we actually move through FY15 and deploy our lending system, that will start to free up resources as well.
Look, I think we covered the lock.
Sorry, I was meaning the other parts of runoff. You've talked about sort of around the Victoria book and issues around there, and how we think about that next year.
Look, the way to think about what we're doing with and there's been quite some compositional change in the branch network that you will note. There is a macro driver which says customers are changing the way they interact, and a branch looks very different today than it did 10 years ago, and it will look very different going forward than it looks today. And we're obviously cognizant of those changes. In addition to that, there are a number of our branches that are relatively poorly located. So as we go through, whether that's a change or whether it's an end of lease term or whether it is a retirement of an owner-manager event, it is a horses for courses decision at each individual branch as to what do we do with that. Do we consolidate it? Do we turn it into a corporate branch? That's the exercise that we're rolling through at the moment, with the overlays that I talked about around customer preference and a recognition that we're not going to renew a lease in a location that we think is suboptimal, and we're taking a different approach to where we want to locate branches going forward to get foot traffic.
I think a really good example of that is some of that dexterity that we're talking about. If you go out to Macquarie Shopping Centre, that is a shopping centre that has a footfall of 10 million or more people, and that is increasing as they expand that centre. Now, we've just recently opened up an Icon branch, and the past experience I've had when you go into these shopping centres is you've got to actually get the right micro location. And we did a lot of work to understand footfall traffic, branch design, and got what I believe is one of the best locations in the Macquarie Shopping Centre, the thoroughfare through the food court all the way through to David Jones. And it's very, very early days yet, but we've seen some really nice results come through in our Icon branch. So again, it's horses for courses around the branch network.
In relation to your question around the rollout of the new system, if you think about a traditional bank that, let's call it, is growing at system growth rates, and they have any pre-existing digitised platform, and you're changing them onto a new system, there will naturally be some indigestion, training, learning, shifting to new systems. To be honest, whilst we have to go through that exercise, the processes that they have to go through today are that manual and that archaic that degree of impact that you would naturally see in a changeover of systems for a front line, given what we're going from and to, I think means that we're probably not going to see the same degree of slowdown that you otherwise would see. Not to say that we won't be immune to any of that. Clearly there's a training requirement as we roll this out, but again it will be progressive. So you'll have some parts of the network that will be on the new system, reinvigorated, ready to go, whilst others still on the old, and it'll be a transition over that course of the rollout.
Okay. Any more questions on the floor? No, I don't think we have any questions on the phone. Last chance for a question? No? In that case, we will leave it there. Thank you very much, everyone.